Why does saving for emergencies feel so hard, even on a good salary? Because most people get the target number wrong from the start. They either save too little and get wiped out by one bad month, or they save too much and leave their money doing nothing in a savings account earning 2 to 3%. In this video, we're going to fix both problems. I'll show you exactly how to calculate your real emergency fund number and exactly where to keep it in India so it's instantly accessible and actually earning something. An emergency fund is not a year of your income. It's a stretch of your survival expenses. Split your spending into two buckets. Your survival bucket, rent or EMI, basic groceries, utilities, insurance premiums, and minimum loan payments. Your comfort bucket, dining out, streaming subscriptions, new clothes, travel. In a real emergency, the comfort bucket disappears entirely, so don't fund it. Your target equals survival expenses times 6 to 12 months, depending on your situation. Salaried, stable job, no dependents leads to 3 to 4 months. Sole earner with dependents leads to 6 months. Freelancer or variable income leads to 9 to 12 months. Dual income household leads to can lean closer to 3 months. Example, if you earn 50,000 rupees but only need 27,000 rupees to keep the lights on, your 6-month target is 1.62 lakh rupees, not 3 lakh rupees. That distinction alone can cut your target almost in half. Don't try to save the full six-figure number on day one. That's how people give up in week 2. Start with a starter buffer of 75,000 rupees to 1 lakh rupees first. This small cushion does the real work early on. It turns a flat tire, a broken laptop, or an unplanned hospital visit into a mere inconvenience instead of a crisis. Without it, every surprise expense becomes credit card debt, and credit card debt at 30 to 40% interest will devour your ability to save faster than you can build it back up. If you're carrying high interest debt right now, build this starter buffer first, then attack the debt, then come back and finish your full target. Order matters here. One more thing before we get to where to keep this money, pause your other investing, stocks, crypto, extra SIPs, until this fund is built. An emergency fund is the foundation of your financial house. You don't decorate the roof if the foundation isn't poured yet. Quickly ruling out the wrong places. Not equity or equity mutual funds, since markets can be down exactly when you need cash. Not real estate, obviously not liquid, and not a fixed deposit with a long lock in and a steep premature withdrawal penalty because that defeats the entire point of instant access. Here's the actual allocation to use for where this money lives. 10% as physical cash for immediate, right now needs, no bank involved at all. 20% in a separate bank account with a sweep in facility, a different bank from your daily spending account, so there's a little friction between you and impulse spending. 70% in liquid mutual funds, short term debt funds that typically return 6 to 7% and let you withdraw within 24 hours. Let's go deeper on the two that actually hold most of your money, the sweep in FD and the liquid fund. A sweep in FD works like this. You set a threshold in your savings account, say 50,000 rupees, and anything above that automatically sweeps into a fixed deposit earning FD rates, typically 6 to 7.5%. The moment your balance dips below the threshold, funds sweep back automatically. No paperwork, no penalty, often instant. Pros: fully insured up to 5 lakh rupees under DICGC, zero ongoing effort, instant liquidity, zero market risk. Cons: interest is fully taxable at your income slab rate and the return is fixed, no upside. A liquid fund invests in very short term debt, treasury bills, commercial paper, government securities maturing in under 91 days. Returns run 6 to 7%, similar to FDs, and redemption typically takes one working day, with many funds now offering instant redemption up to 50,000 rupees. When picking one, look for three things: high AUM, over 20,000 crore rupees, so it can handle large redemptions without stress, AAA or sovereign rated bonds for maximum safety, and a low expense ratio, so more of the return stays with you. Pros: Competitive returns, slightly better tax efficiency on larger sums held over time, professionally managed credit quality. Cons, not zero risk, small NAV fluctuations are possible, redemption isn't as instant as a sweep in FD, and you need an account with a fund house or platform set up in advance. So, practically, your 20% sits in the sweep in FD for the portion you might need at a moment's notice medical, urgent repair, anything today. Your 70% sits in the liquid fund, since that portion is more likely to be needed over days, not hours, and it earns a comparable or slightly better return in the meantime. Two habits that make this actually happen. First, automate the transfer on the day you get paid, not at month end when there's usually nothing left. Second, rename the account. Don't call it savings, call it freedom fund or family security. Your brain protects money more when it has a meaningful name attached to it. And remember the rule of three before you touch this money. A true emergency is urgent, necessary, and unexpected. A flash sale is none of those. Quick recap. Your target is survival expenses times 6 to 12 months, not your full income. Start with a small buffer before chasing the full number and split where you keep it 10% cash, 20% sweep in FD, 70% liquid funds. So you get instant access where you need it and better returns on the rest. This fund is what buys you quiet freedom, the ability to walk away from a toxic job or handle a crisis from a place of calm instead of panic. Next video, we go deeper into health and term insurance in India, what cover you actually need, and where standard advice gets it wrong. Subscribe so you don't miss it.